gold will continue to serve its purpose. But a day will come when people, grim and unwilling, accept that the cure must be taken of austerity and fiscal restraint. When they do, the case for gold will end. That is when it should be sold. That is when your profits should be taken. We are nowhere near this type of event.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lanci. This is the Gold Fix Market Rundown, and it's 8:11 a.m. There are the markets. Talk about those in a second. Front page, podcast, gold, stablecoins, and the next bubble. We feel that the future of gold ownership, not necessarily for you if you're over 40 or 50, but the future of broadening of gold ownership will be, stablecoins will be key for that. We have evidence of that in Asia, and now we're starting to see it in the US. Money is being invested into it. It's very early in the game, and we have a long, thorough podcast to that effect, and we recommend you take a look at it. It's the industry as it's developing in the context of how Wall Street will use a product to get people into a product they otherwise would not use. So gold, they need a better way to get people to use gold, and stablecoins are a way to do that. It's going to cannibalize ETFs. HSBC, that was our story yesterday. We're going to talk about the top right-hand story there today. Post-pandemic student loan delinquency is bad. And there's that story. You can look at that while I'm taking a look at the markets. 10-year yields are up a point. The dollar is up 9 at 97.56. The S&P 500 is 62.61, up a handle. The VIX is 15.9. Gold is up $6, was up about 12 at 33.19. Silver is 36.63, up 26. That's off its highs. Copper is 5.52, up almost 6 cents. That's off its highs, but still pretty strong. WTI 68.18, down 60. Natural gas 3.16, up almost 3. Bitcoin hovering right under new all-time highs at 110.890. Platinum, palladium mixed. Palladium up 24. Platinum down 4. Gold, silver down 48 at 90.57. And grains are mildly mixed with wheat up 3 cents. Okay. Saw a slide deck report from Apollo, right? And they manage a lot of retiree money. And so they're very interest rate oriented. They're very bond centric. And they had a nice presentation on student loans. And the reason it's timely is because all those people that were given forbearance or didn't have to pay their loans during COVID, well, that's finally being undone. And now, poof, a lot of people are defaulting. So post-pandemic student loan delinquency is bad. That's an understatement. Apollo Global Management's latest report flags a growing risk to the resumption of federal student loan payments. With 45 million borrowers and 24% of those in repayment already delinquent, over 11 million Americans could see their credit scores fall, limiting access to loans for basic goods like cars and appliances. Parenthetical statement. The report focuses on the result could be credit scores falling, which would give you an idea how much that the firm has invested in bonds not collapsing. Oh, your credit scores could fall. Well, what about the rest of the economy? And I'll come to that in a second. Defaults are rising now. For context, this is us talking, not the report. For context, the subprime crisis triggered systemic collapse at under 10% delinquency. Here, we're already past 20. The difference, well, the government is absorbing the slow bleed behind the scenes. The problem is your credit rating, not your defaulting to us. The student loan system as a functioning financial engine is effectively dead, in our opinion. Continuing on from that report, student loan debt accounts for 9% of total household liabilities, disproportionately affecting 30 to 59-year-olds. This cohort drives consumption. Credit deterioration here means weakening demand economy wide. See, they're focusing on if people don't have money to spend to buy stuff, then the economy will get hurt. And that's a valid way to look at it. Um, Apollo calls that a persistent drag on the economy. Uh, a bigger portion of your income, if you have any income, is going towards paying debt service, right? We call it a permanent headwind. Here's why. There are 59-year-olds who are still marked as delinquent. That money is lost. Okay, so there's two red arrows in that picture. See if I can make this bigger. Yeah, those two red arrows, look at this. 40 to 49-year-olds, 50 to 59-year-olds, red arrow mark, those people are late. They're not late. They're dead. Economically, they're dead. And that's tragic, right? But it's also money you're not getting back. They're not going to, like a company would have to mark that as a loss or set aside money as a loan loss reserve. The government doesn't have to do that. The government prints it later on. But right now, it's like everyone knows that there is no Santa Claus, but they're just not going to admit it. Look at this. You have 60-year-olds and plus with student loan delinquency. This doesn't even include forbearance, forbearance. We're going to let you kick it down the road without forbearance is delinquency, but they're not going to include it. This is insane. Give you an idea. There's like a rule of thumb that's no longer a rule of thumb, but it was pretty effective if you're looking for a math grid. A 5% decrease in a crop yield yields a 20% increase in price. So it's like a factor of 4. And maybe it's more, maybe it's less. All right. So a 24% decrease in crop yield means a 100% increase in price. Now, when you're looking at debt, it's the reverse. If 24% of your people aren't paying their debts, then you're in default. Like your whole structure is dead. That's my opinion. And we think that's very important because there are whole towns built around colleges. And if you're not getting a student loan, people are going to not go to college anymore. And it will continue to be that way until colleges start teaching what needs to be taught and are not resting on the laurels of a neoliberal era. Okay, so that full analysis is in the premium post. Post-pandemic student loan delinquency is bad. We're just saying it very plainly. Next, related posts. There's the podcast we recommend you listen to. Founders AM, that's Copper Recon. That's a little bit of conversation about the effects of Trump's copper tariff, which is going to happen. Moving on, coming soon, and this is all building on copper, right? So coming soon, white gold, the U.S. must become lithium independent to reindustrialize. That's a typo by me there. Onshoring critical metals starts with copper and it ends with lithium. And when to sell your gold. Now, we'll get to that last one in a second. It's not a panic comment. If mercantilism, those of you who've been here a long time, deglobalization after COVID led to mercantilism. Everyone pulled their own things back. Supply chains begin to be onshored, reshored, and friendshored. And the first phenomena we saw that took place, first profitable phenomena we saw took place under Biden, and that was chips. Chips are money. We need to build our own chips. And the second phenomena of that is you're seeing the tariffs. The third phenomenon is tariffs buy time, and they also encourage domestic production of a product. So, for example, with copper, we're going to tariff copper because we need to develop our own refining of copper. So we have a lot of raw copper, but we end up sending it to someone else to refine for us. We've outsourced our manufacturing, so to speak. With lithium and other rare earths, we need to get it here because we're dependent on China. And so if you're in Trump's corner, aluminum, tariffed, steel, tariffed. These are industries that he needs to protect and grow. Copper, tariffed, right? So we're addressing all the areas that we need to create manufacturing in to help our own industry. And rare earths are next. Zero Hedge has a very good premium article on that. And we're going to probably quote some of that because their coverage is very good. Anyway, what chips were under Biden, rare earths may be under Trump. AI has been under Trump, but that's not something that we focused on. Anyway, we're going to do that. We're going to have a big piece on that this weekend, and we're going to go through why we think that industry is, white gold, right? It's another gold as far as I'm concerned, and it's industrial white gold, and it's going to be very important. And the key is if we're not buying China's white gold, whose are we? Well, we have to find the companies that are going to be involved in that, and you want to own them. We don't do a lot of equities, but we do it when we think there's a big play coming up. When to sell gold. Okay. Dylan Grice at SocGen wrote something years ago. We didn't read it until yesterday, actually. Today, I think. Well, midnight. Let's put it that way. And he was talking about gold in 2011 after it crashed. And he was saying it's not time to sell gold. And he said, but if you're trying to figure out when to sell gold, I'll tell you. I'm going to paraphrase him. There will come a crisis, a real one, unmistakable and severe. We haven't had it yet. When it arrives, the political weather will turn. The breeze of wishful thinking will give way to a hard wind that cannot be ignored. At that point, the country will be steered by necessity towards fiscal restraints. Okay. Until then, until that happens, the impulse to inflate away risks like student loans, okay, will persist. So too will the economists who justify it, armed with equations and lexicon and jargon that sound precise but explain nothing. Precise but not accurate. Their theories will say inflation is safe, even helpful. And that's happening right now. Like I'm looking at stories right now. Well, inflation might not be bad. Lowering rates could actually make the cost of things go down. It's insane. Okay. Their theories will say, I already said that. Their theories will say inflation is safe. Okay. Even helpful. As long as that belief persists, gold will continue to serve its purpose. But a day will come when people, grim, I can't believe I wrote it this way, grim and unwilling, I'm channeling Orwell, I think, accept that the cure must be taken of austerity and fiscal restraint. When they do, the case for gold will end. That is when it should be sold. That is when your profits should be taken. We are nowhere near this type of event. The reason we even thought about this is we were looking at the one big better bill, one big beautiful, the bubble bill, right? And we were looking at the bubble bill, and had we even been looking at the path I just described, that bill would not have passed as it did. It passed with cost austerity measures. You must make cuts, but you can kick it down the road. So you could delay cost cutting, but spending can't be delayed. Spend now, save later. That's basically it. So we are nowhere near this type of thinking, but you have to think it. Gold makes a new high, gold goes in a range, and then the bill passes. And then I start reading about inflation is your friend again. And I go, doesn't anybody get it? So nobody has gotten it. We're going to talk about that this weekend as well. Moving on, Thursday is jobless claims. It's 8:25 now. 'That'll probably be out at the end here. All right. And Oh boy. All right. So gold's in a range, right? I want to look at silver for a second here. No predictions yet, but see when this happened, when these Bollinger Bands got really tight. And you see these yellow lines tell me that, give me an indication that they're tight enough. And now here we are again, they're tight enough. So let's say that the market can go another 5 to 8 days in this sideways thing here. And when that happens, it will move. And then when it moves, when volatility starts to exhale, right now it's inhaling, and then it will exhale, and then the market will pick a direction and it will be violent. Now, could it be lower? Yes, it could be lower. It happens in both directions. But I see a trend of rally. Okay, that's bullshit. Rally, sideways, exhale, sideways, exhale. I think this whole complex is going higher. He's not tariffing silver, but he's tariffing silver. I'm Vince.
Well, thank you, Vince, as always, for today's show. Appreciate that update and hope you found that helpful at home. Fortunately, good times in gold and silver over this past year and a half as we have seen the prices rally, and certainly now as we have another BRICS summit behind us. A lot happening out there in the world, and fortunately, I would like to thank Fortuna Mining, who brought us today's show and has been one of the companies that not only benefited from the rising gold price, but also the timing of their decision to build that mine at Seguela, which they did on time and on budget in the midst of an inflation surge. So really impressive what they've done there, although perhaps more significantly with people wondering, okay, well, the gold price is up. When does that hit the miners? Take a quick listen to what Jorge said here in our call following their first quarter earnings.
We went from record to record. In Q4 2024, we had record free cash flow of $96 million. And into Q1 of 2025, we reported, as pointed in the news release, record again in free cash flow of $111 million. That means we increased our free cash flow margin quarter over quarter from 31% to 38%. That's margin of free cash flow over sales.
So that is the advantage of when you have a company that is well run and in the midst of a gold rally. A lot of good things happen. And fortunately, to find out more about their progress, well, you can just click on the call that's coming your way now.